Hello, friends. Welcome to the monastery where mindful trading meets order flows. I'm a doctor turned trader. I have been in markets for 5 years and I have tried out all kinds of mentorships, indicators, and strategies during this period. However, I could understand that there was something really lacking, a big hollow lacuna. I started to search for it and I realized that it was objectivity. Because for me and most of us, we have a natural tendency to linger to things which are objective. We like measurability. And then I discovered the order flows. It was the SMC concepts and the order flows that really helped me in changing the course of my trading journey. And then now I am a consistent, disciplined trader. I have seen many traders who resonate with this idea of objectivity, and that's why I thought of starting this channel where I can share everything that I have learned and I'm following. You will learn all the concepts and tools that have helped me and the ways by which you can also become a mindful trader. Last but not the least, this one singular thing has to be always remembered, that Rome was not built in a day. If you are committed, patient and ready to put your efforts, I can promise that you will make it. Trading is a game of probability, skill and patience. And all these three factors need time to build. If you are ready to be systematic in practicing the skills, which I'll be sharing in my videos, you will gradually advance to a level where things will become almost automated. It's just like learning to drive or learning to use a typewriter. Initially, it seems difficult, but later things change and you are driving the vehicle without conscious efforts. You are talking to the person by your side and still doing everything needed to run the vehicle, almost unknowingly. You are typing without consciously looking at the keys of your typewriter. You have experienced it, isn't it? So just be consistent and patient. Having said that, let's start learning. We are starting a new series from today. This series is dedicated to volume profile, and you will be learning this tool from the beginner to advanced levels. What is volume profile? Volume profile is a tool which plots the actual traded volume horizontally on the graph. There are two types of volume profiles: the dynamic volume profile and the fixed volume profile. The DVP or the dynamic volume profile shows the traded volume in real time, and the FVP or the fixed volume profile will provide the data after candle close. By candle close, I mean that this can be at the end of the day or any range of candle you have selected. Many people fail to differentiate between volume and volume profile. Volume or the traditional volume is plotted vertically and is measured on the basis of time, a time-based measurement. So it tells you what happened in the market during a period of time or a point of time, and the traders compare this information to the corresponding candle to draw insights. Whereas volume profile is a price-based measurement and is plotted horizontally. A price-based measurement which tells you how much the market has traded at a given price level. So a volume profile highlights the concentration of trades at a specific price level. Now let's see how does the volume profile actually appear. Let's quickly go to the charts and apply the VP tool. Now here we can see two clearly demarcated areas with color coding, that is green and then blue. This area, which is green, is called a high value area, HVA. That means the market has spent most of the time in this area, and that all means that market has made most of its trades in this area. And again, this area was the most comfortable area for the big market participants or the institutions, because they were able to materialize their plan in this area. And what was that plan? Either buy or sell and to deploy the capital for it, or better say, slowly infuse the funds over a stretch of time so that they can act out the plan. However, value areas have an upper and lower limits, the blue color, and that area is the low value area. And as you can assume, this is the area where the participants were not quite happy to be in, or you may say that the institutions were not quite comfortable in this area. Now, as you know how to identify a high value area, a low value area, and the limits, that is the value area high and the value area low, let's go to another important plot, the line called the point of control. It's also called the POC. The POC is a level at which the maximum number of actual trades have happened. Or you may say that this is the exact level at which the participants were most comfortable within the comfortability area. Now, let's try to understand the market behavior and logic using volume profiles. This is how you can use volume profile in your trading. Interested, right? Markets move in cycles of balance and imbalance. Balance is clearly seen in the comfortability areas or the high value areas. Here, the price is most accepted. Things are good and price is agreed to. Market keeps rotating within this area to facilitate trades or comfortable trades and does not intend to leave this area. But suppose due to some reason there is a disagreement, there will be an immediate turbulence and uncertainty which will lead to a move. The movement with the intention to find a new comfortability area. Nobody likes disagreement except us, isn't it? Let's see that on a chart. Here you will see that the price is in balance within the high value area. Then the market moves, a sign of disagreement, and the probability of disagreement or discomfort increases as you approach the low value areas. So there is a possibility of rotation back to the comfortability area when the market approaches the low value area. Until where will the market rotate back? It is usually to the POC. The POC works almost like a magnet, pulling the price towards it. As you now know that the POC is the place where maximum number of trades have happened, this also means that most contracts changed hands here and most traders have position near this price, and inventory is most balanced here. So when price moves away from the POC, some traders are in profit and some are in loss. So many of those traders want to adjust their positions, and this causes the prices to reach back to the POC. Let's jump into the next part of this video, the 7-day challenge, market mapping with volume profile. Actions speak more than words. Deliberate, intentional actions will fetch you the results. It's a simple 7-day observation challenge. This exercise will help you in developing the skill to read market intention and develop a logical explanation for the market behavior. You start with 7 days, continue the exercise for another 14 days and complete your 21 days so that you develop neural networks which can help you in developing the convictions. And those convictions will develop as soon as you add the volume profile to your chart. The first look of the volume profile mapped on the chart will give you the trigger to understand the market behavior. This is going to be a very easy exercise and you have to follow the directions. That's all. So now this is what I want you to do. For the next 7 trading days, do this every morning. Step 1. Select your most familiar trading instrument. You have to check your calendar and note down the 22nd day from today. This is going to be called the day of reference from which you are starting this exercise. We will abbreviate this day as the R day. The next day is the first test day. You can abbreviate it as the T1 day from where you will start your observations. Add the volume profile to the reference day's chart. Mark the POC, value area high and the value area low. Step 4. Now observe the chart of the T1 day. Observe the high value areas and the low value areas. Step 5. Observe and note down. Is the market opening inside or outside the previous day's high value area? Is the market opening near or far from the previous day's POC? How did the market behave on opening inside the high value area? Was there an early rotation? Did the market return to POC? Did you see a false breakout? Or did you see a slow price development? How did market behave on opening outside HVA? Did you note a consolidation near the opening? Was there a continuation of movement? Did the market return to HVA? Did it return to the POC? Did it return to the opposite low value area? Or did the market broke the low value area? Now let's get into the self-reflection part. This is very important and you have to do this every day. You have to ask this question to yourself and note down. Can I locate the market comfortability areas on all test days, that is from T1 to T21? If you had any discomfort in finding out these comfortability areas or you had any confusions, you have to note it down. I hope you enjoyed the learning. If you have any doubts, don't hesitate to revisit the videos. And most importantly, if you have understood the content of the video, please go through the exercise. Complete your 7 days challenge. Don't forget to like, share and subscribe this video if you find it helpful.